Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month lead and tin. I'll start with LME 3-month lead. I've prattled on and on about how great a comfort it has been that the market has kept within the breached but still not yet broken and seemingly valid May to October 2020 bullish shift pitchfork, originally drawn easily over a year ago. To recap some of the significant actions. Late September saw a halt to a decline, stopped dead by the lower time, currently 22.34 of this same broken May to October 2020 bullish shift pitchfork. However, 2 weeks ago the market breached, one could say broke the lower time, plus the slowly rising long moving average, currently at 22.75. Indeed, this was a serious breach lower with three consecutive closes below the lower time, yet the market did not pour down through it. Instead, prices volte-faced and rose up to a considerable distance towards January's highs. I suspect this was due to two things. One factor and a self-fulfilling action. The one factor was the 50% Fibonacci on the March to October 2021 move at 21.80. This stopped the fall dead. What turned it around and back up were the almost daily indecisive doji crosses made 2 and 3 weeks ago, and especially the indecisive doji made on Tuesday 2 weeks ago. Significantly, this was immediately following a large bearish engulfing pattern. There was enough doubt to cause a bullish closing long white Mariposa on the following Wednesday, bringing back the long moving average into play. This was followed by bullish hanging man patterns over the weekend 2 weeks ago. Then last week, the market made two significant bullish moves. It punched up and closed over, firstly, both the short, medium and medium moving averages, currently 22.93 and 22.98 respectively, plus the upper time of the important late October 2021 to January 2022 bearish Andrews pitchfork, currently at 23.07. This bearish pitchfork had seen its middle time, currently at 21.49, though a bearish time still slowed the decline as recently as 3 weeks ago. It seems this pitchfork is now paying for that effort of slowing the market going down. Meanwhile, overhead, we now have the upper time, currently at 23.63 of the bearish shift pitchfork for the same move as the Andrews. That is pressing down on this market and interestingly causing the market to roll down the top side, or the outside if you like, of the upper time of the original bearish Andrews pitchfork. This is the only reason why I have still kept this broken bearish Andrews pitchfork on this daily chart. There's one other final question, one I put out there last week and one I would like to revisit once again. Is the mid-October 2021 today action a possible double bottom? It's in the wrong place, I can give you that, but there's definitely elements of it there, of that pattern. Maybe we could look at it as a cat's ears pattern, but this is something for next time, and it is worth considering. I'll leave you with this one thought. It is derived from my last commentary, and it deals with the psychology of testing the now broken lower time of the May to October 2020 bullish shift pitchfork. And I quote, "Take special care over this, as at least 2 consecutive closes below this lower time, probably more in actuality, will be needed to break it. The market tried back in late September and failed. Just take care this time. It may well be that the move lower might still be a trap, and the recent bearish action has sprung it. Thus, we have so far ended back where we started at the beginning of January, in a bullish frame of mind. Please remember this also from last time, and I quote, this broken May to October 2020 bullish shift pitchfork that has been so effective in guiding the market higher is still, after all, a bullish shift pitchfork. And until this bullish pitchfork is truly destroyed, then it will still guide the market higher, all the while. All these comments are still valid. LME 3-month tin. I'm sorry if you've heard this first bit before, but it is so necessary, I'm afraid. So here goes once again. I've been repeating this bit again and again for almost a year now. It is this. The overall bullish incentive is still alive, well and strong here. This was and is because of the original move up within the January to March 2021 bullish shift pitchfork that started back in March last year and then translated to a higher level in April, resulting in prices moving up over the middle time, currently 41,620, of this bullish shift pitchfork. Prices have also managed to reach up and over the upper time, currently 44,000, back in July, August, mid-October, mid-November 2021, January 2022, as well as each of the last 5 weeks. Yet in all that time, including the last 5 weeks, the market has always tended to come back within the folds of the same bullish pitchfork. In all that time since March last year, this bullish pitchfork had and still does drive prices higher. Now, admittedly, I, and I'm sure you as well, believe that no market can head in one direction all the time, forever. Though this metal is giving a pretty good impression of such a market. This is why we saw major corrections back down in August, late September, late October, and even 4 weeks ago. It's important to note that despite these corrections, the market in all its pullbacks down has never ever managed to break this same bullish incentive. That's been seen here since March. The evidence for this can be seen by how this market is still this week within, if only just, the same bullish shift pitchfork. However, over the last 5 weeks, prices have been moving up and have tested and breached the upper time above, currently at 43,000. Now, there's another point I'd like to note, and this may become very important, though it is far way below. And that is the lower time, currently at 39,300, has not been challenged for some time now. This has allowed a close bond to develop between the lower time and its long-term partner, the rising medium moving average, currently 39,470, since at least August last year. Now, this is not canon, but it may well be that if we see a separation of these two, a separation between them, between the lower time and the medium moving average, then perhaps, only then, may we start looking at the bullish incentive as maybe finishing. This is no more than conjecture on my part, at this time anyway, but it does have a certain symmetry to it. So I suggest special attention to those two and upon their separation. Meanwhile, the most recent action has indicated yet another possible fresh attack on the upside, with a new and seemingly valid and more acute January-based bullish shift pitchfork. This has seen good work between the lower time below, currently 43,685, and the middle time above, currently at 44,000. This is something to also watch for, as it has looked very good corralling the market higher during the last 4 weeks. However, a crossover point is coming up with the lower time crossing up over the upper time of the January to March 2021 bullish shift pitchfork. Now, this happens at the end of this week and is something that one should pay close attention to, as you may see volatility on the back of it. This brings me once again to my final point. Same final point which I've repeated now from previous commentaries many times. It is this, and I quote, "It can be hellish to rely on only one pattern because it can be hellish when it breaks." So that's it. That is where we are now, once again. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright AD Tofpik and ADM Investor Services International Limited. And here comes the final bit.